Will buying a rental save me on my taxes? Or what are the passive activity rules all about? A common question I get from clients is, will buying a rental save me taxes? Most people are under the impression that real estate will generate losses and save taxes. My answer is maybe. Let's look at why. What can I deduct? The discussions about real estate tax rules can go on for hours, but since this is only a 5-minute video, my discussion will assume that you would be renting not to family members. Renting to family members would create a whole other video. First, property taxes and interest are almost always deductible from rental income. Other expenses include those incurred in keeping up the rental: insurance, repairs, utilities, advertising. When purchasing the property, the cost is always allocated between land and building, usually based on the property tax bill allocation. This will determine the amount of annual depreciation, since land is not depreciable. Depreciation rules have only 2 lives that can be used for rental real estate. For residential real estate, the building can be depreciated over 27.5 years. Commercial real estate, such as a warehouse or an office building, the life is limited to 39 years. For the year the property is placed in service, depreciation can only be taken for the number of months the property is owned. That is why purchasing rental property at the end of the year doesn't have a big effect.
Let's do that.
Depreciation rules have only 2 lives that can be used for rental real estate. For residential real estate, the building can be depreciated over 27.5 years. Commercial real estate, such as a warehouse or an office building, the life is limited to 39 years. For the year the property is placed in service, depreciation can only be taken for the number of months the property is owned. That is why purchasing rental property at the end of the year doesn't have a big effect. When can I deduct it? As soon as the property is considered available to rent. So if you buy a rental, take a month to fix it up, expenses incurred during that month probably will be capitalized. But if you put a for rent sign out front and no one rents the property for 3 months, you can still deduct any costs for maintaining the property. Limitations. Rentals are always considered a passive activity. This is a special term that means losses will not always be deductible in the year incurred. The passive activity rules cover pages and pages of the Internal Revenue Code, so I won't go into details here except to explain how losses are limited from rentals on an individual return. All passive activity losses and gains during the year are netted to determine how much of a loss or income will be shown on page 1 of the tax return. The amount of a rental loss that can be deducted in any one year on page 1 is limited to $25,000 in total from all properties. If your modified adjusted gross income is over $100,000, the $25,000 loss will be reduced until it reaches $150,000. Then there is no current rental loss. But the loss is not gone forever. The loss is carried over to the next year, where it can be used to offset other passive activity income, or if the property is sold, it can offset the gain from the sale. These losses are called suspended losses. Real estate professional exception. If more than 50% of personal services of the taxpayer during the tax year are performed in real property trades or businesses in which they materially participate, and they spend more than 750 hours of service during the year in real property trades or businesses, then the real estate rental activities in which they materially participate are considered non-passive activities, therefore are allowed 100% on page 1 of the return. Definitions, definitions, definitions. The tax rules governing rental real estate are complicated because there are many definitions. For instance, a passive activity is a trade or business in which the taxpayer does not materially participate. Material participation is defined by satisfying one of 7 tests, which includes spending more than 500 hours participating in the activity during the year, or being the only individual that substantially participates in the activity. And then there is active participation, which applies to rental real estate. Active participation means that the taxpayer must have substantial involvement in managing the rental. Managing a rental includes arranging for others to provide services, such as repairs, approving new tenants, or approving capital or repair expenditures. So, will buying a rental save on taxes? The answer is a definite maybe. The link below the video will take you to our website where you will find the text of this presentation.